Hi and welcome to Swissquote Daily Market Talk. It's Wednesday, May 14th. Trade optimism and strong earnings from the S&P 500 companies continue to improve sentiment in US indices, while appetite for the European indices wane on the lack of good news from the trade front and a surprise jump in the Eurozone's inflation numbers. So we will talk about all that and more, but before we do, please keep in mind that opinions are my own and this is not financial advice. So the trade news keeps getting better. Yesterday, it was the chipmakers' turn to lead the rally as the Saudi Crown Prince Mr. Mohammed bin Salman pledged to spend as much as $1 trillion in commercial deals with the United States. And at the same time, Nvidia CEO Mr. Jensen Huang announced that Nvidia will be selling chips to Humain, which is a Saudi Arabian AI company, for a massive data center project. Now remember, the US was restricting its chip sales to Saudi Arabia and United Arab Emirates for national security reasons under Biden administration. So the news came as a major relief for the US chip companies at a time when the worries regarding a slowing demand from the US big technology companies has been mounting. And of course, the budgets that these companies like Google and Meta put in play for their AI spending are very, very hard to match and replace for Nvidia. So the news that Nvidia and also AMD could now sell their chips to Saudi Arabia and could do the same with the United Arab Emirates is excellent, but excellent news for the US chip makers. So the news obviously echoed quite well across the US semiconductor stocks yesterday. Nvidia jumped open the session above its 200-day moving average yesterday, gained more than 5.5% during the session, and the stock is up by nearly 50% since its April dip, while AMD, on the other hand, extended its own gains above its own 100-day moving average, above the past 6-month descending channel range, and also above the minor 23.6% Fibonacci retracement level on the past year's decline in the stock price. Now, broadly speaking, the AI demand certainly remains robust as an increasing number of industries and companies are obviously looking to implement AI solutions for their businesses to improve cost and productivity. Yet the trade uncertainty of late put these investment plans and the budget and the capex on a pause. So that was a situation that could have led to a temporary slowdown in AI activity. Therefore, the idea that sales to Middle East will come to eventually counter that trend, that slowdown expectations due to trade war, is an excellent news per se and should throw a solid support under the US chip makers' feet, in my opinion. Voila. So good news there. Besides the Saudi news, investors also took a quick look at the US inflation update at yesterday's trading session, which actually showed that inflation past month accelerated in the US on a monthly basis, but accelerated less than penciled in by analysts. On a yearly basis, the headline CPI figure in the US is to 2.3% level, which is the lowest level since spring 2021, marking also the third straight month of a lower than expected CPI print. So this is obviously good news for the Federal Reserve and the Fed does, although the softness that we see in the US inflation numbers is taken with a pinch of salt as core good prices have yet to reflect the impact of the tariff hikes that have taken place since February, warned the chief economist at Fitch yesterday, joining the crowd of economists suggesting that the US retailers may have continued to sell their existing inventories, whereas the new imports will be reflecting the additional cost of these new tariffs. As such, the encouraging inflation data from the US yesterday didn't necessarily move the Fed expectations much in terms of market pricing. The US 2-year yield was flattish near the 4% level. Investors expect the US Federal Reserve to cut its interest rates 2 times this year, but the first rate cut is not penciled in anytime before the FOMC September meeting. So interestingly, the easing trade tensions between the US and the rest of the world have been pushing the major US indices higher, but appetite for the US dollar remains limited, mind you. The dollar index gave back gains yesterday despite improving trade optimism, while the S&P 500 and the Nasdaq 100 in the US extended their rebound. Funnily, the S&P 500 has now erased the year-to-date losses and is just 4% away from an all-time high level, while Nasdaq 100 also rebounded more than 4,600 points since its April dip and is just around 1,000 points from its all-time high level reached in February this year, remember, leading many analysts and economists out there to improve their outlook for the US indices. On a side note, the decoupling that we saw in Dow Jones Industrial Index yesterday was mostly put on the back of an 18% slump in the United Health Group shares after the company's CEO resigned and is not representative of the rest of the index and of the rest of the companies that are in that index. So all in all, gains in US indices are accelerating on trade optimism, but also on the back of a significantly stronger than expected earnings season. In numbers, the first quarter earnings growth for the US companies, for the S&P 500 companies specifically, reached 13.1% compared to a 6.6% growth expected by analysts before the start of the earnings season. So that's a very good beat, mind you. Then the negative impact of the gloomy forecast or the lack of forecasts due to the tariff uncertainties are also being gently overlooked with improved trade optimism of the moment. In fact, Citigroup's earnings revisions index has just turned positive for the very first time this year. The latter is obviously boosting appetite in US stocks despite the hawkish Fed expectations and the rising yields in the US, whereas across the pond, gains in the European indices remain quite limited these days, helping the US indices to close the earlier gap between the two continents. Now, the surprise heating that we saw in the Eurozone inflation figures in the month of April have actually softened the European Central Bank those hands over the past weeks, and the stalling trade negotiations between the US and the European Union are obviously weighing on sentiment across the board, even more so as the European leaders are watching these days the US officials strike deals with elsewhere in the world, including China. And in the sense, the US Treasury Secretary, Mr. Scott Bessent, warned earlier this week, remember, or if you heard that negotiations with the European Union will likely take more time as the European leaders must first agree among themselves to then negotiate with the United States. So it starts feeling like Europe is returning to its old usual habits of too cautious and probably too slow to act that could eventually cost the European indices their encouraging advance of the first 4 months of this year. In the FX, the euro-dollar rebounded yesterday after hitting the 50-day moving average level, but sentiment in the euro is also revised from positive to neutral. A softer euro combined with the recent rebound that we see in energy prices may further ease the dovish European Central Bank expectations, and the latter could further limit gains across the European indices going forward. In the UK, well, some analysts were actually very much furious to see rising unemployment rate in the UK and the slowing wages growth, screaming out that the Bank of England is sleeping at will because it should have eased its policy more preemptively to prevent the slowdown in the UK jobs in the light of higher taxes that were announced back in last October already, and also the heated trade war. So whether the Bank of England will wake up and cut its rates is uncertain, but the soft data of yesterday certainly gave a boost to the Bank of England dose and also supported a rebound in sterling past the 1.30 3 level against a broadly softer US dollar, while the euro gave back all of its post-April 2nd gains against the pound on the back of incoming trade deals still between the United Kingdom and big trade partners, including India and the United States, while no deals have yet been announced on the European front. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.